Everyone thinks the stock market is some kind of high-tech financial wizardry run by algorithms that dream in spreadsheets. It's not. It's a 400-year-old idea based on a simple human need, the desire to get rich without doing much work, and the terror of going broke alone. Before stocks, if you wanted to fund a risky sea voyage, you paid for the whole ship. If it sank, which it often did because oceans are large and 17th century boats were basically ambitious wooden bathtubs, you lost everything. Your family would have to sell your fancy hat. People got tired of losing their fancy hats. The solution was to get a bunch of people to chip in. That way, when the ship inevitably hit a kraken, everyone was just a little bit ruined instead of one person being completely ruined. It's the principle of collectivized failure. Inspiring, isn't it? Enter the Dutch East India Company, or VOC, in 1602. These guys weren't just funding one ship, they were funding an entire colonial enterprise with its own navy and a questionable moral compass. They were the first to issue permanent shares you could buy and sell. Suddenly, you didn't have to be a shipping magnate to invest. You could be a baker, a butcher, or just some guy with a few extra guilders, and you could own a tiny piece of a global empire. The trading happened in coffee houses in Amsterdam, which means the world's first stock market was fueled by caffeine and gossip. This also introduced limited liability, a fantastic concept where the company can rack up insane debts, but the investors can only lose what they put in. It's like being able to bet at a poker game using someone else's money. Humans have always been good at inventing ways to fail with fewer consequences. Of course, once people figured out they could trade pieces of paper for money, they immediately lost their minds. This brings us to the South Sea Company in Britain in the 1720s. It was granted a monopoly on trade with South America, which was great, except Spain controlled South America and wasn't keen on sharing. Minor detail. The stock price shot up over 1,000% anyway, based on pure, uncut hype. Isaac Newton, a man who literally invented modern physics, invested, sold for a profit, got FOMO, bought back in at the top, and lost a fortune. He later said, "I can calculate the motion of heavenly bodies, but not the madness of people." This was the first great lesson. The market isn't about fundamentals or logic, it's about guessing what the next idiot is willing to pay. And there's always another idiot. Over in the colonies, they decided to get in on the action. After the Revolutionary War, the new U.S. government had a lot of debt. A brilliant man named Alexander Hamilton had an idea. Let's turn this debt into something people can trade. So, in 1792, 24 guys met under a buttonwood tree on a street called Wall and signed an agreement. The buttonwood agreement basically said, we'll only trade with each other, and will charge everyone else a commission. This wasn't some noble enterprise for the public good. It was an exclusive club designed to make its members rich. They created the New York Stock and Exchange Board. For decades, it was a private party where insiders traded information and fleeced the general public. Because nothing says land of the free like a members-only financial system set up under a tree. The 19th century was when things got really spicy. The Industrial Revolution needed money, and the stock market was the place to get it, especially for railroads. Building a railroad across America was colossally expensive, so companies would issue stock, lots of it, sometimes more stock than their company was actually worth. They called it stock watering, a term borrowed from ranchers who would force cattle to drink tons of water right before selling them to make them heavier. Financiers like Jay Gould and Cornelius Vanderbilt didn't see the market as a tool for economic growth. They saw it as a personal playground for ruining their rivals and manipulating prices. They would start rumors, corner markets, and issue fake shares. It was less about investing and more about institutionalized backstabbing. The Gilded Age, they called it. Seems appropriate. Then came the Roaring '20s. For the first time, regular people piled into the market. It was the great American dream. Get rich quick. People were buying stocks on margin, which is a polite way of saying with borrowed money they absolutely did not have. The logic was flawless. The stock price will go up forever, so you can just sell it later to pay back the loan and pocket the difference. Everyone was a genius. Your barber, your milkman, they all had hot stock tips. The market became completely detached from reality. It was a nationwide fever dream of infinite prosperity. And like any good party fueled by cheap credit and delusion, it was followed by a spectacular, world-altering hangover. On October 29, 1929, the whole thing came crashing down. Shocking, I know. The Great Depression was so profoundly awful that the government decided it should probably, do something. This led to the creation of the Securities and Exchange Commission, the SEC, in 1934. Their job was to be the financial sheriff, to stop companies from lying about their value and to prevent insiders from rigging the game. They introduced rules about transparency and disclosure, forcing companies to actually publish accurate financial reports. What a novel concept! It was a good faith effort to turn the casino into a respectable institution. And for a while, it sort of worked. The market became a bit less like the Wild West and a bit more like a heavily regulated, slightly less dangerous Wild West. But humans are creative, especially when it comes to getting around rules that stop them from getting rich. Flash forward to today. We have computers that execute trades in microseconds. We have complex derivatives based on other derivatives. We have intimidating acronyms like ETFs and CDOs. It all looks incredibly sophisticated. But peel back the layers of technology and what do you find? The same old story. People on Reddit deciding to pump up the stock of a failing video game store out of pure spite and memes. Billionaires tweeting a dog picture and watching a joke cryptocurrency's value explode. The fundamental driver hasn't changed since that coffee house in Amsterdam. It's not about balance sheets or price-to-earnings ratios. It's about psychology. It's about fear, greed, and the collective, often irrational, belief of a very large crowd. The technology just lets us be irrational much, much faster. If you enjoyed this video, please like, comment, and subscribe to our channel for more historical insights. Thanks for watching, nerds.